Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Welcome to the Business Line State of Economy podcast. In this episode, we'll be exploring the major trends that shaped the startup ecosystem in May 2023. Last month witnessed a surprising drop in valuation of multiple unicorns by the private investors. We'll delve into the reasons behind these markdowns and their implications for the startup landscape. On a positive note, new exemptions in the angel tax provisions have brought relief to the foreign investors. We'll discuss how these exemptions will impact the investment climate. Joining us today, Arun Natarajan, founder of Venture Intelligence, a private market intelligence platform, and Siddharth Pai, co-founder 314 Capital and co-chair Regulatory Affairs Committee, IVCA. Welcome, Arun and Siddharth.
Hi.
To start off, Arun, can you please give us an overview of the startup funding activity in May, and can you compare it, the volume and deal sizes in April 2023 and May 2022?
Sure. We tracked about 53 VC type investments worth about 7,500 crore or less than $1 billion in May 23. These figures are actually down 51% in volume terms and 44% by value terms when compared to May 22. Compared to the immediate previous month, April 23, that is, the figures are actually up, 15% by volume and significantly higher thanks to one large, cross-border investment. So from a sectoral perspective, I think the investments in the venture side of things are dominated by B2B and, within that enterprise software kind of investments. We tracked as many as 22 investments this month as is May 23 versus 27 in the same time last year. And like we've discussed earlier, AI, ML, especially vertical focused ones, as well as climate tech and EV within that, are also doing well compared to May 22. Having said that, the numbers don't compare well enough to even 22, let alone, 2021. And it looks like it'll take some time for various segments. For example, seed investments have been kind of doing well. We recorded 25 such investments, but even that was compared to 53 in May 22. And Series A and B deals are, down to single digits actually. So we are quite a ways from catching up with 22 even. And it looks like, things are going to be slow, but, we're looking at a month-on-month progress rather than anything else at this point.
Arun, also, can you talk about the M&A activity in the ecosystem now? Are there any sector-specific trends that you have noticed? Or?
Absolutely. It is clearly a case at this point of stronger hands taking over and quite a bit of consolidation, however way you slice the deals. So, for example, as we saw a bit earlier in the year in the case of Lenskart, and in this month, Purple, the personal care products unicorn, the sovereign wealth fund ADIA came in strongly to take some equity away from existing investors and then put in some primary capital on top of that. And then we saw a very interesting deal in the form of a specialist private equity secondaries fund called Foundation Private Equity come in and buy out 3 companies from Carpe Diem Capital. That's more of a venture come growth equity fund, from their earlier fund. Some of these funds hadn't taken probably money off the table in the go time of 21, and even early 22. Now they are actually cashing out to kind of get that money off the table, so to speak. So that's on the venture funded startups. We also saw, very interesting deals by Mindtickle, Apple, in terms of going out and acquiring companies in the valley. And obviously there is far more kind of venture funding winter in other geographies. India is relatively far better off. And, these companies are kind of taking that plunge. Clearly well-funded companies. Apple is listed as well, and they are taking the opportunity to go and consolidate, even overseas. So looking forward to seeing, more of this. It is stronger hands taking over, and which is a very good sign. And a player like Foundation Private Equity giving liquidity to VC funds, clear sign of maturing of the startup VC ecosystem here.
Arun, also, we saw multiple VC firms like Matrix and Chirate closing new funds recently. Do you think the investor sentiment is improving now? Can we see more deals going ahead?
Clearly, there is a disconnect between the actual money flowing and, the dry powder sitting with the VC firms. We've seen tracked as much as $9 billion being raised, by India dedicated VC funds since 2022 beginning. I'm sure this money is going to flow quite quickly to some of the deserving startups once the valuation, etc., expectations get realigned. Matrix $550 million, and then it follows, funding from other Silicon Valley VC firms, starting with Sequoia, Lightspeed, Accel, between $2 billion among all of them, just raised since the middle of last year, right? So, and obviously, we have homegrown VC funds. 314 is a good example, $200 million fourth fund. Bloom Ventures, again, $250 million fourth fund. These are domestic and led funds who also have some foreign money as well. And Shirate, like you mentioned, they've raised a growth capital fund, $123 million, 1,000 crores plus. And we've seen venture debt funds, Stride Ventures raising their $200 million third fund. There's lots of money, lots of dry powder waiting for the right opportunity as we see it. So clearly, a good sign of opportunities to be tapped going ahead.
Siddharth, would you also like to weigh in as a co-founder of a VC firm? Why is there this disconnect between lying dry powder and the number of investments we see around this time?
Yeah, I think that's actually a fantastic question. I think we're seeing a marked dislocation between LPs being bullish on India versus fund managers actually deciding to take the plunge itself. I think one of the reasons there are actually several reasons for this. If I break it down into two broad categories, one I think is there's still a negative sentiment around whether this is actually the bottom or not, or whether valuations can actually end up softening a bit more, whether we can actually end up driving a bargain, such that nobody actually wants to actually catch a falling knife. They prefer the knife to actually fall, and when the rebound happens, to actually end up picking it up at that. So I think it's a timing issue that's actually causing VCs to end up taking a bit of a long-term view when it comes to making these kind of investments. I think the second part, I think we've actually seen there are still some skeletons in the closet of the Indian startup ecosystem that are yet to actually come out. I think recently also we've seen a fairly large, prominent investor actually open up a forensic audit of one of his portfolio companies as well, just to understand where a large amount of the money actually went. And what we are seeing is even though there are deals in the pipeline that are being actively negotiated by founders, by VCs, by law firms, etc., the turnaround time has actually increased by a factor of at least 2.5. So if a deal would actually take about, let's say, 2 months to close previously, now it actually takes anywhere between 6 to 8 months to end up wrapping up itself. And even some of the deals that have been announced recently also, they've actually taken a much longer time to end up actually closing compared to what we've seen previously. So I think these are the India-specific factors that are actually tracking upon it. On a macro situation, I think most of the influence of the Russia-Ukraine war has already been baked in. I think there's a greater amount of clarity that the US is also stabilizing right now, and that interest rates should not actually end up rising. And there is actually a marked sentiment that the later stage ecosystem should actually end up waking up. Now, one of the dislocations we've actually seen is that later stage firms are actually staring at massive holes in their balance sheet as of now. So most of them are extremely reluctant to end up actually taking on new investments. They're actually looking at the existing portfolio, trying to actually get them to profitability, trying to actually plug those particular holes. And most of the follow-on rounds that we're seeing also happen in the form of convertible notes, where even the cap on those notes is actually at a discount to the last round's valuation itself. So I think people believe they may have overpaid for some of the assets in the previous years. They're looking to rectify that as of now. So when their fund actually do come to an end, they do actually manage to get the IRR they actually promised to their LPs itself. So I think it's this sort of dislocation is in terms of raising capital for follow-on for their new funds, whereas actually protecting the existing portfolio and making sure to maximize value wherever they can itself. So it's this weird dichotomy that's happening, which is why there's a large amount of dry powder, but very few deals are actually happening in the market.
What could be the potential reasons for this trend? Can you give us some reflections there?
I would actually prefer to differentiate between accounting markdowns as well as valuation markdowns, wherein a company is actually raised capital at a much lower valuation itself. Now, most of the accounting markdowns that we've seen are actually driven by a combination of the accounting standards that apply to these various investors, particularly the public market investors or the listed ones who end up actually having to do this far more aggressively than their unlisted private capital peers. And the second one is actually the risk frameworks that these particular institutional investors end up having. Now, what the accounting standards actually state is that on a quarterly basis, you need to end up marking to market your companies. It's like, oh, whatever assets and investments that you've actually made. Now, in the absence of any subsequent financing round, and where the divergence between the projected plans of these companies that underpin the valuation report, as well as actual performance is fairly large, what most of their auditors or what most of the risk teams actually insist that these investors end up actually marking down these particular valuations itself. Now, these are temporary dislocations, and they actually differ from investor to investor. If you notice, even in India's largest unicorns right now, the markdowns amongst various investors have actually varied to a large extent. I think there's about anywhere between a 20 to 40% difference in their own markdowns itself. And there are several investors who continue to hold these assets on their books at the latest round of funding. So we're seeing these kind of dislocations actually becoming more investor specific for that matter, as opposed to the valuation markdowns where a company is forced to raise capital at a much lower valuation. So I don't think we've seen any down rounds happen as of now. Most of the investors and most of the founders have been fairly smart to structure their investments as a convertible note. Now, to 2022 actually saw a large number of convertible rounds. 2023 is also seeing some number of convertible rounds right now. But I think a price round is in the offing. And when that happens, you'll truly have a barometer of investor sentiment as to whether these companies were actually fairly valued in their previous rounds, or whether the valuation was actually a combination of low interest rates in the previous regime, a large amount of surplus liquidity, as well as investor ebullience that actually carried that entire thing forward itself. So I think we need to differentiate between these two. Obviously, there is a strong signal that's actually being sent when a fairly large investor ends up marking it down. But I think what most of the incoming investors are looking to see is that the largest investors on the cap table are actually marking it down. That's a strong signal. We've actually seen some investors hold anywhere between 1% to 3%, end up aggressively marking down these companies. Now, obviously, in their entire portfolio, there would be far larger investments that they've actually made, which end up actually carrying value. So these smaller markdowns are something they don't actually mind tolerating to a large extent. And unfortunately, India ends up actually reading very, very deeply into what is essentially driven by accounting standards as opposed to driven by actual cash coming in. So that differentiation, I think, is important. Larger institutional investors also look at a company in terms of its fundamentals, in terms of its sentiment, as well as a larger potential that they have. So I think until we start seeing these sort of valuation or investment driven down rounds, that's when we actually know that the bottom is actually hit. And we should actually start seeing a recovery from that thereafter. And this recovery will start, as Arun also mentioned, in the early stage itself. Early stage numbers also still look fairly good when you compare to the later stage peers. And it's obviously early stage guys who end up actually raising capital and then thereafter starting off the next virtuous cycle itself.
So that what is your outlook on down rounds?
I think what's very important for founders in the unlisted space to also acknowledge is that your valuation is not a permanent factor of your business. If you look at the listed market, we've actually seen the valuation changes on a second by second basis for that matter. And most of the listed market, if you look at the CEOs and all that when they end up speaking, very few of them actually end up commenting on their stock price unless there's a severe dislocation that can be attributed to their own performance. Even during COVID, if you recollect, very strong companies, very strong short stock that were still actually throwing out free cash flow and have been doing so for a long time, saw their valuations crater by about 60%. That was a marked dislocation. None of them actually started panicking or doing anything of their like. So I think valuation has sort of become a sort of vanity badge for a number of founders. And the quicker they end up dissociating valuation from actual performance for that matter, and start actually considering performance, I think it's actually a sign of maturity for the entire industry itself. Valuation is great, someone valued at a point in time, but valuation is always ahead of value creation. It's always incumbent on the company to actually grow into that particular valuation. And that's why we've seen the category creators and market leaders in certain areas, they're concentrating a lot more on actually cutting down costs and turning profitable. Because the moment they do, and they start showing some amount of sustained profitability, they know they can attract a large amount of capital that's actually waiting on the sidelines itself. So valuation is great, but it's at a point in time. It's not going to be fixed over there forever. You need to end up doing a lot more in terms of your business to make sure you actually earn that valuation and end up increasing it over time as well.
Thanks, Siddharth. Coming to the regulationary bit, one of the major announcements that happened last month was CBDT saying that we are going to announce some changes in angel tax provisions. They said some exemptions as well. Would you like to comment as a member of IBCA? What are the reactions to those exemptions? Is the investor community at large happy with them?
So I think as IBCA, we welcome the fact that the government, the CBDT, has actually offered clarity on angel tax. Section 5627B has long been a bugbear on the entire Indian startup ecosystem, where we've seen a sort of anti-money laundering rule actually becoming a tax harvesting rule when applied selectively to a number of startups itself. And I think we've seen a dislocation between a law that was put on the books in 2012, whereas actual startup activity, which has been going on over the past 6 to 7 years, there's been a marked divergence as to how the department as well as industry has actually viewed this entire angel tax itself. Now, the biggest thing I think, Yati, is India. The reason why angel tax has actually spooked a large number of investors ever since they announced it in the 2023 budget is because close to 80 to 85% of the capital coming into the Indian startup ecosystem actually comes from international investors. And most of these actually come into later stage companies. As Arun's actually put out in his reports on numerous occasions, the largest rounds that actually happen in later growth stage companies are dominated by foreign capital actually coming in. So if we look at it, 80 to 85% actually goes towards foreign capital. About 10 to 12% actually comes from domestic AIFs and venture capital funds, private equity funds, etc., such as ourselves as well. And the remaining portion actually comes from family offices, CXOs, and smaller corporate investors. Now, because of the fact that 80% of the capital actually came from overseas, angel tax was predominantly focused at early stage companies because the later stage guys raised foreign money but actually exempt. Now that even the foreign capital is actually come under the ambit, it did actually cause a severe dislocation when it came to the funding market and actually exacerbated the entire funding winter itself. Now, even with the latest safe harbor rules that CBDT has actually put out, one alarming point to note is that the largest sources of FDI into the country have actually been omitted. If you look at the RBI annual report, and it just came out on May 30th itself, as well as the previous year for that matter, the 5 largest sources of FDI into India in some order is actually Singapore, followed by Mauritius, followed by the US, followed by Cayman, and then either Netherlands or Switzerland, depending on which year you end up looking at. But if you actually look at already top 5, Singapore, Mauritius, Cayman, and then Netherlands are actually excluded. Even the UAE, which has actually been extremely bullish on India, and we've seen a large amount of not just sovereign wealth funds as well as private capital actually come in, have actually been excluded from this. Now, even though the government has stated that if you're a sovereign wealth fund, if you're a bank, if you're an insurance company, if you're a university endowment and the like, you're actually exempt if you come from these kind of countries. The exclusion of Singapore, Mauritius, Cayman, etc., has actually caused flutters around. Singapore has long established itself as a preferred investment destination for investments into Southeast Asia. And we're only now actually seeing India-dedicated funds from larger foreign institutional investors end up getting created. Otherwise, India was usually part of their Southeast Asia strategy, which would normally be run out of Singapore itself. Now, given the fact that these particular countries have actually been put on the negative list as of now, as they're not part of the safe harbor provisions, a large amount of investor concern still remains that in case they do actually invest into any of these startups, or even not just startups, but even other unlisted companies for that matter, there's a good chance that 25% of their investment may end up getting paid as tax into the hands of the taxman itself. Now, the biggest problem with angel tax hasn't actually been the valuation methods that have actually been around. In the BAR Act of the Income Tax Act itself, it's stated that the valuation has to be done to the satisfaction of the assessing officer. And what we've often seen, even when a few of our portfolio companies actually face angel tax issues and were thankfully able to get out of them over time, is that the assessing office would actually compare your actual performance to the projections that you put into your valuation report. And the moment the divergence was fairly large, they would disregard your valuation report and actually tax the entire share capital premium as income in the hands of the companies itself. India is unique as a country, wherein we actually tax capital investments as income. No other country, I think, in the world actually has this particular piece itself. So the entire industry as a whole has raised these concerns to the CBDT, raised these concerns to the government to say that, look, you do have a safe harbor list, but what are the reasons why these particular countries have been exempt? These are the legitimate kind of investors who arise from this. If there are certain bad actors that you believe are there, how can we actually work with you to ensure that if there are good actors who actually come in, they can actually come in under the safe harbor rules, and there's enough disclosure and transparency built in such that any errant actors trying to come in can't take advantage of the system itself. So the entire industry, no one from the industry is actually countering that it is important for India to actually stem the flow of black money actually being laundered through these kind of investments. This has happened in the past, and there was a reason why this law actually came onto the books. But the misapplication of the law is something that all of us are actually against. And even the government is actually taking cognizance of that. Those discussions are actually going on right now. And we are hopeful that we should see some sort of clarity actually coming out sometime soon as well.
Thanks, Arun and Siddharth, for your valuable insights. That's all for today's edition. Stay tuned for more exciting episodes of State of Economy podcast.